And welcome into the program, Your Course to Retirement with Grand Rapids Certified Financial Planning Professional, Ron Courser, CFP. Ron, always a pleasure to have you here on the program.
Well, hello, everyone, and hello, Peter. Welcome, everybody, to today's program, Your Course to Retirement. We're going to have a really great discussion today. We're going to talk about something that's the front part of everybody's brain when it comes to their money, and that's something called risk. It is a four-letter word, but it's okay to use it in public. So we're going to talk about this. What do we do with it? How do we define it? What is risk? One of the Supreme Court justices, when they were talking about pornography, said, I can't define it, but I know it when I see it. And risk kind of is in that same category. It's hard to define sometimes, but man, when we see it or feel it, we know how to talk about it and define it. So let's get into it. Again, I'm Ron Courser with Cornerstone Retirement Partners. If you need help trying to figure out how much risk you're really willing to take, or how much is in your current portfolio, or any other questions concerning your finances, your retirement plan, give us a call here at Cornerstone Retirement Partners at 616-301-2581, 616-301-2581, or please go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there and we'll reach out to you and help you get the answers you need to make really good financial decisions. You can also tune into this program here on our website too. In fact, all of our other programs are on it too, that you can download and view at your convenience. There's a lot of great information in there. And if you take the time to look at it, some of it I'm very sure will apply to you and help answer some questions for you. So let's get on with it. Let's talk about risk. What is risk? There's a lot of ways to define it. Some people say, well, risk is scary. It is scary. But when we think about it, risk is really the potential you have to lose something. So when it comes to your money, risk could be defined as, how do I do something, or am I afraid to do something because I don't want to lose money? I don't want to lose principal. I don't want to have a loss. And if we think about it, sometimes we get a sense, I think, and I've been doing this for close to 28 years now, talking to people, that you feel as if, well, I can't control risk. And my response to that is, yes, you can control risk. You do it sometimes unconsciously, and other times consciously. What do I mean by that? Well, let's think about this. Before today's program, Peter and I were talking about speed limits. And I said, in Michigan, I think speed limits are a suggestion. They're not really something that you need to really follow to the letter. So the speed limit on an expressway is 70 miles an hour. You can drive 55. You get a lot of people aggravated at you, but you can do that. You can also drive 105. And you'll get some people aggravated at you doing that, but most likely you will encounter a federal or a state employee who will not look upon you as really a good corporate citizen because you're about 35 miles an hour over the speed limit. Unless you behave properly, you could end up in jail that night. So how do we control risk? One, obey the speed limit, right? That's simple. But think about the other parts of our life that have risk in it. And what do I mean by that? Think about this. You have medical insurance because healthcare can be expensive. You have home insurance because if your house burns down or a tree falls on it, you need to replace it. You have car insurance. If somebody steals your car or you get an accident, you need to have money or assets to fix it or replace it. You may even have life insurance, which is protection against perhaps dying and leaving your family a little short on income, or wanting to leave a legacy to somebody. So we intuitively know that we have to handle risk, and we do it. Unfortunately, I think sometimes when it comes to our investments, our financial future, our financial welfare, we don't have the ability, or we don't have somebody to help us take the same rational approach to how do we manage risk. Now, there's no way to totally get rid of risk. All right, let's just agree to that. There's nothing I can do to help you on the expressway or anywhere else. But what we can do is we can help you minimize the risk, to help you control it, to minimize the impact of a bad experience on your life, particularly with your money we'll have. Most of us remember the horrible experience in 2008. That came upon us suddenly, but slowly, and then suddenly, and people were caught kind of off guard dramatically. A lot of people were harmed, some irrevocably harmed. They've never been able to come back from what the losses were in their portfolio. So when it comes to risk, understand two things. Number one, you have the ability to somewhat control it and minimize it. And number two, you have the ability, if somebody will help you, to understand how much risk you really are taking in your financial portfolio. And that's what we're going to focus on again. Again, I'm Ron Corser with Cornerstone Retirement Partners. Give us a call if something that I've mentioned already has kind of tapped into your, oh, I think I want to know more, or I need to talk to somebody. Give me a call at 616-301-2581, 616-301-2581. We can talk about risk. We can talk about the questions you have relating to risk, which are very important. No matter how silly they may seem, they're not silly at all, because if you don't manage risk properly, it can be damaging. So give us a call again. I'm Ron Corser, 616-301-2581 with Cornerstone Retirement Partners. So let's move forward here. How much risk should somebody take? How much risk, to those of you listening to today's program, how much risk should you take? You can take a lot and you can take a little. And what's interesting, I don't know how to define that for you without knowing more about you. I can't tell if what you have now is too much risk for you or too little risk for you. So it takes a conversation. That's what we do here at Cornerstone Retirement Partners. We have a real serious conversation about risk, about what it is, about what your concerns are, about how to minimize it, to make sure that whatever the future brings, it has potentially a good outcome. Now, one of the things I always say to people, and we always say it, is when it comes to risk-taking, you can take more than you need to achieve your goal. But it really is key in my own personal life with my wife, Nancy, and when we counsel our clients. Let's figure out what's the least amount of risk you need to expose your financial assets to. What's the least amount of risk you have to take to get what you want, your money to do? Because the flip side of risk-taking is answering the question, what is it you want your money to do for you? If you want your money to double every year, you got to take a lot of risk. We may be talking the roulette wheel or Bitcoin in spades. If you want to say, I need X number of dollars for my whole financial life, what's the least amount of risk I have to take to get that? So there's a lot of ways to approach it, but if you can define, and we can help you define it, how much you need from your life savings in terms of income and how much risk you have to take to get it, we can put that together for you and create a really great plan for you that will do both things, give you what you want potentially with the least amount of risk. So how do we do that? Well, think about the term, what's appropriate? I hear this a lot. When I tune into seminars and I attend them and people talk about appropriate risk, it really gets down to you as an individual, and it gets down to what you're trying to achieve. Because what's appropriate for you may or may not be appropriate for me in my circumstances. We've all been raised with the idea, haven't we, that says, well, if you're going to make a little money, you got to risk a little money. So I guess that's kind of true, but the question becomes, how much is a little bit of money and how much is a little bit of risk? So when it comes to creating a plan, keep this one point in mind, that the whole purpose of understanding and managing risk is to make sure that you have an income plan in retirement that reflects the kind of risk you want to take on, how much you want to take on, and gives you the highest probability of success in terms of getting the income that meet your lifestyle day in, day out for as long as you live. It can be a little complicated, but sometimes it's not as confusing as what I just said. What's the least amount of risk you have to take to get what you want so that you can maintain your lifestyle? And ultimately, risk in investing, think of it as a funnel. You're pouring risk into something, investment ideas and strategies into this funnel, and it's going down. What's at the bottom of the funnel? Your retirement income plan. You want money coming in every month, every week, however you want to do it, so that you can maintain your lifestyle, buy groceries, do everything, but also do some of the things you wanted to do once you stopped working and were in that semi-retired or retirement time. So think about that. Everything's going into a funnel. Ultimately, the purpose of putting everything into that funnel is to come into a piece of time, really, where you have a great retirement plan because it's a great income plan. So a lot of times risk is built around, how do I protect my income? How do I make sure that no matter what happens, good markets, bad markets, zombie markets, terrible markets, things that I have no control over, how do I make sure that that's not going to impact how much money I need every month or every year coming into my checkbook to live, to do what you want to do? So that's what we're going to continue to talk about here today. Again, I'm Ron Courser with Cornerstone Retirement Partners. We're talking about risk, what it is, how to manage it, what it's good for, what it's not good for. Give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you with this most important thing called risk in your portfolio.
So, Ron, you've been speaking about risk and volatility. How can we be best prepared to deal with volatility and risk?
That's a great question. Volatility probably is the more important of the two. Risk is sort of a general idea that I might lose some money, I might lose some principal, but as volatility is the killer. What do I mean by that? What is volatility? On a daily basis, if you're one of those people that track the market for 8 hours a day, you see the markets, it goes up, down, green, sideways. At 2 o'clock in the afternoon, it could be really hard green. And by 3 o'clock in the afternoon, it's deep red, and you're wondering what in the world's going on. It's that up and down stuff that goes up and down, sideways. You're not quite sure. Volatility is what really creates problems for investors. We understand the idea of risk, but you need to understand what volatility is, because that's what you have to build a buffer against in your portfolio. On a long-term basis, if we think about this, one of the old tried and true truths is the markets always go up. They do. Historically, over the last 250 years, they have always gone up. The problem comes in those time frames where they can go 5, 10, 15, 20 years and never go up. And you're caught in this kind of, I call it a matrix. Can I take that word? Where the markets are going up and down sideways. They may gain a little bit, then they lose a little bit. They may gain some and then they lose some. And you're trying to figure out, my goodness, how do I manage this? Because every year that I need income from my life savings, I need more. So how am I going to get more if the market is just going up and down and sideways? It's not going up in a very dramatic way. So the key to dealing with risk is really uncovered underneath it is, how do we deal with volatility? How do we make sure that what we're doing isn't going to get splattered on a wall if the markets go down 10% in a 3-month period, or the markets go down like they did in 2008? Or if we look back at COVID, the market went down 31% in 11 days when they shut the market down. That's some serious volatility. And that's what can make people crazy, but also can destroy a retirement income plan. So in dealing with volatility, you have to understand what kinds of things, what kinds of investments, what kinds of buckets of money, so to speak, can I put my cash into that will do two things. That will give me, number one, the income I need, but number two, not expose me to the incredible ups and downs that can happen in the stock market. How do I keep it as level as possible, as humanly possible? And the way to do this is to take a hard look at the kinds of things you've put your money into. So let's back up for a minute. Why are we saving all of our lifetime to get to retirement? We're saving so we have enough money in retirement to give us the income we need so that we can enjoy retirement and hold on to our lifestyle and take care of things that just happen, healthcare, whatever's going on. Buy a new truck, buy a new car. We need income to do that. The whole point of retirement planning, believe it or not, is to create an income plan that can survive on a long-term basis and give you the best probability of success. So what kind of things are we putting in our income plan? That's where working with us makes a great deal of sense. Yeah, I'm biased, I admit that. But we take a look at all the different options in terms of what kinds of things you can put your money into that will do two things. Keep volatility as low as possible in your portfolio, but give you all the income you need. So we're not a one-trick pony shop of the stock market is everything. The stock market's a big deal. I don't underestimate it, but I don't believe it's the only thing, because there's some other things that I know people are doing right now. You're buying CDs because the interest rates are higher, and that gives you a great deal of comfort. But the other thing it does, it helps reduce volatility in your overall retirement plan. As you know, whether it's a 7-month CD or a 3-year CD, yes, inflation is going to eat away at some of it, but you know at the end of that time period, you're going to get your money back. So you don't have to worry about then, do you, whether the market went up yesterday or down yesterday or going crazy yesterday. So that's one of the ways, real life example of how you are already dealing with the idea of volatility by taking some of that money and putting it into CDs, money market funds that are going to be there. Yeah, we're going to have to deal with some inflation issues, but that keeps your dollars there. That's one way to deal with volatility. So there are other kinds of places, other kinds of accounts that you can use to decrease the volatility in your overall portfolio and still make sure that you have the best probability, not only of success, but to give you all the money you need coming into retirement. So what else exists in our life that decreases volatility? In an indirect way, in a goofy kind of way, Social Security does, doesn't it? Or if you have a pension, you have money coming in all the time. It's not going to be impacted really by what happens in the stock market. Pensions really aren't going to be impacted by that generally. Social Security isn't. Whether the market goes up or down, your Social Security is going to come in every month. You may get a little bump if inflation goes up, interest rates go up. But that's another way of saying, look, I've got an income stream here that's been shielded against stock market volatility. So finally, what's left? Well, if we're going to put money in a stock market or other financial kinds of things, what's available out there to help us reduce volatility, because that's the key to controlling risk, and also give us what we need in terms of income. So let's talk about this. Number one, you can buy dividend-paying stocks. And I'm not giving advice here. I'm just saying here's some options. You can buy dividend-paying stocks. Warren Buffett thinks they're a great idea. I think they're a great idea too when they're appropriate for the person, given their risk parameters and on how they look at the stock market. So that's an option. Another option is you might want to buy bonds that have supposedly less risk in them. But keep in mind, last year, 2022, the stock market went down 19%. The bond market also went down. That's only happened like 5 times in the whole history of our stock market. So people found out last year that bonds were not, quote, safe. So what else is out there that we can invest in that helps us minimize the impact of volatility? Well, we've talked about dividend-paying stocks. We talked perhaps bonds. Certainly bank stuff will do that. Well, how about another kind of account that's not created by Wall Street? It's created by life insurance companies called annuities. There are 2 kinds of annuities, a variable annuity And it's very important to understand a variable annuity is nothing more than a stock market option. It's not going to do much with volatility control. But a principal protected fixed annuity, it's not impacted by the stock market. It will help minimize the volatility in your overall portfolio and give you the income you need. So you see, there's probably more options out there when it comes to controlling risk and volatility than a lot of us or a lot of you perhaps have been exposed to because of the kind of advice you've been getting. I'm Ron Corser with Cornerstone Retirement Partners. When we help people with their retirement planning, we look at everything and try to figure out what's the best possible combination of ingredients to use in your retirement plan to create an income plan that has the best approach to giving you everything you need in retirement, including income, but also minimize the impact of volatility and risk on your long-term savings. Because, when you're retired, you don't have a do-over, do you? You don't get a mulligan. So you have to be very careful of that. So if this is important, if we've touched on something that makes some sense to you or you want to learn more about it, give me a call. I'm Ron Corser with Cornerstone Retirement Partners, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there, and we'll have a conversation with you and help get you the information you need to make really good decisions for yourself, your family, your children, your grandchildren, things that have the highest probability of success that will work for you. So give us a call again at 616-301-2581.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.